Thank you. Well, gold is a fascinating asset class, isn't it? It's well regarded as a commodity and also widely acknowledged as a form of currency. It's shining, shimmering, splendid. And today, well, my name is 𝗪𝘆𝘀. I'm the head of intermediary for Southeast Asia at State Street Global Advisors. And I'd just like to talk to and share with all of you about how to use gold in your portfolios and our outlook for gold. Okay. So gold as a strategic asset has got several users in any investment portfolio. So first and foremost, very importantly, is diversification. I think throughout today's sessions, this term has been mentioned many, many times. I mean, diversification is really the only free lunch in the world. And why is gold important in diversification is really because it has demonstrated a low and negative correlation to many financial asset indices out there. What does this mean? This means that the likelihood of gold moving in tandem with the S&P 500 or the STI or broad-based equity indices is low. Chances are if one goes up, the other either has no correlation or it might actually have a negative correlation and would go down instead. Gold has actually seen pretty good returns, despite a lot of feedback that, gold is not a dividend-paying asset class. So if you buy gold, you buy a physical gold, you put it in your safe, it's not going to pay you dividends. It doesn't generate you any passive income. But what has the returns of gold been like? I was just doing a bit of study on this, and I thought, let's look at HDB prices. So it's a big topic nowadays, right? $1 million HDBs, in fact, $1 million, I think of a past now, it's $1.5 million. But it wasn't always this high. When Singapore first became independent in 1965, average 5-room HDB flat cost about $30,000. So it seems very cheap now. And back then, if you were to use gold to buy a 5-room HDB flat, you would need approximately 27 kilos of gold. So 27 gold bars. You've seen those 1 kg gold bars, right? 27 kilos of gold. You can buy a HDB flat back in 1965. Today, if an average BTO 500,000 5-room HDB flat, right, that same 27 kg of gold would buy you 4. So throughout time, gold has actually appreciated in a way that a lot of us probably has not been able to appreciate, right? It's hitting record highs today, and that's why it's a topic of interest. Furthermore, gold also provides good liquidity. You can buy and sell gold anytime, regardless of whether it's in the form of an ETF, you just buy and sell it off the stock exchange. Even if you're holding physical gold, anyone or any shop would really take your gold as a currency, so that liquidity is strong. Why is it also important? It's because of the dual nature of gold. What do I mean by this? Global gold demand, we kind of split them into 4 parts: jewelry, industrial, investment, and central banks. So jewelry, I think, no need to explain. You buy gold jewelry, but we also include gold bars as well as gold coins within this component of jewelry. It actually accounts for the largest proportion of global gold demand at 51%. This is a cyclical driver. It means usually when the economy is good, more people will buy gold, right? Then the gold prices will tend to go up when the economy is good in a sense. Industrial, now AI is a very important topic. Semiconductors, microchips. Gold is actually a very crucial component used in these industrial manufacturing activities. So that accounts for about 8% of annual gold demand. And investment, of course, ETFs, futures, accounts for 28% of global gold demand. It's a counter-cyclical. Typically, when markets are good, ETFs actually see outflows. People start selling gold as an investment. And of course, central bank buying, which is non-cyclical because central banks buy gold typically due to geopolitical tensions, and it's regardless of whether the economy is good or not good. So what I'm trying to say here is that regardless of whether there is stock markets are going up, stock markets are going down, there's always that strong demand for gold. And what we have generally seen is that gold is a very good risk management tool. So this is a 30-year historical correlation of gold compared with all the rest of the asset classes. So if you look at correlation with, say, for example, the S&P 500 is 0.05, that means there's almost no correlation at all, right? It's not like REITs or gold miners. In fact, I often get this question, what about gold miners? Now, gold miners are actually quite correlated with broad-based equity indices. Gold is not. And we've also did a study on gold's historical use in times of severe equity drawdowns and market turmoil. So for example, let's look at what happened in 2008 during our global financial crisis. Equities were down, really down. It was down about 47%. In that same period, gold actually appreciated by 12%. If you look at the subprime, look at the subprime meltdown, equities dropped by 17%, gold went up by 31%. So, and we have seen this quite regularly, that whenever there is market turmoil, with the exception of COVID, actually, during COVID, when equity markets fell about 33%, gold also fell, but much less, about 3% only. But in times of market turmoil, gold tends to do quite well. Let's get the slide. And of course, I think one very important macroeconomic factor that we're all looking at today is inflation. Gold has always been known as an inflation hedge. If we look at what happens to gold historically since 1971, and why 1971 was because that was the end of the Bretton Woods system, basically was when the US government decided to unpack the US dollar to gold. That's why, in the past, in Chinese, we all call the US dollar 美金, right? Because one US dollar was backed by a certain gold, but not anymore. So technically the right term in Chinese now should be 美元. But, that's why we always use 1971 as a benchmark. So since 1971, in times of low inflation, gold tends to go up about, average real return about 3.7%. However, in times of high inflation, which, more than 5%, gold actually goes up by more than 18%. And again, this has held true this year, right? We're seeing high inflation now, and look at what happened to the, sort of gold prices. We're hitting record highs again. And will we be in a sustained environment of high inflation? Chances are, it seems quite likely the data is coming out, inflation continues to be high. And once the inflation numbers come down, what's going to happen is that the Fed is likely going to cut their interest rates. And once the Fed cuts their interest rates, inflation is likely going to go back higher again, which is good for gold prices. So generally, we're actually quite constructively bullish on gold right now, despite it being at quite record high prices. So how can you use gold in your portfolio strategy? Well, I kind of mentioned this earlier, but just more data to substantiate it. Gold has historically served as a portfolio diversifier. So if you look at the correlation, gold's correlation to equities continues to be lower than all the other alternative asset classes. So if you look at REITs, for example, REITs is very correlated to broad-based equities. In fact, it's 0.7, almost 0.8. Commodities also 0.5, 0.6, but gold very, very low. So you use it as a portfolio diversification tool. And it hedges against equity volatility. I presume most of you might be familiar with the VIX. The VIX is an index that measures the market volatility. So if we look at the VIX in one standard deviation, two standard deviations, and three standard deviations, meaning how volatile it is, you can see that little gold bar there in the chart that the price of gold tends to go up. And the more volatile it is, the higher gold prices go up by. And are we going to face market volatility? Well, chances are with the US elections coming up, a lot of uncertainty there, likely the VIX is going to go up. Likely we're going to see some market volatility. So from that sense, the outlook on gold is actually quite positive. And then interest rates, another very common topic. What happens when interest rates fall? So again, you can see when interest rate falls, in fact, this chart is marked to monthly return, not annual return. Gold prices actually go up by 1 to 2% during periods of falling real rates. So the question, how much gold should you really hold in your portfolio? Definitely not zero. So you can see 5 lines there, and those 5 lines are drawn by how aggressive your portfolio is. So really in a very, very conservative portfolio, let's say you're buying ABF, ETF 100%, Singapore government bonds, you probably don't need much gold in your portfolio, 1%, maybe 0. It's not, it's not really going to improve your risk return characteristics of your portfolio. However, if you're holding a good amount of equities, say standard 60-40 portfolio, 60% equities, 40% fixed income, our study has shown that the optimal allocation to gold is approximately 5%. So at an allocation of 5%, it's actually where the risk return characteristics helps to improve the Sharpe ratio of your portfolio the best. The more aggressive your portfolio is, the more equities, the higher risk it is, the more volatile it is, the more gold you should have in your portfolio, up to 10%, that can really help to improve that risk return profile. So just now I mentioned that we're quite bullish on gold. Why? Well, I think firstly, gold has been performing well despite high interest rates. So historically, in periods of high rates, gold never really performed that well. So we're quite surprised as well this year what has happened to the price of gold. And there's a good reason for it, because gold does not pay dividends. So in a high interest rate environment, when you can put your money in a bank in a fixed deposit and get 5% per annum, 4%, 3%, it makes sense, right? I'm getting good yield. Why do I want to buy a gold bar or invest in gold and I'm not going to get any form of income and I'm not sure where the prices of gold is going to be? So, historically, when interest rates are high, people tend not to like gold so much. But gold actually has been a standout asset class since 2023. Why so? It's really been supported by central bank demand as well as jewelry demand. So as I mentioned earlier, jewelry actually accounts for 51% of global gold demand. Post-COVID, with the opening up of China, with the opening up of India, might sound a bit strange, but actually there's been an increased number of weddings in India, and apparently the statistics show that because of that, gold demand actually has been higher. But yes, so supported by jewelry as well as central bank buying, there has been a lot of central bank buying gold, and that has been what propped up the gold prices. So we're really in a case now where we've got relatively high inflation, we've got high rates, hoping that inflation will come down, and when inflation comes down, the Fed is going to cut rates, and when the interest rates are cut, chances are gold prices will go even higher. So we're really in this situation now where we despite the high interest rate environment, gold prices still rallied because of central bank buying. Then the question then, is central banks going to continue to buy? I kind of talked about this. The Fed's going to cut rate, and in a falling Fed rate environment, you can see that the price of gold actually goes up by close to 1.5% historically per month. So you see a left chart and a right chart. I want you to focus on that light blue bar. So for the light blue bar really shows the percentage of gold as a total share of a country's total foreign reserves. In most developed markets, it's actually close to 60%. The US, for example, out of all their foreign reserves, 60% they're holding it in gold. MAS in Singapore has been increasing their gold reserves quite a lot. They've been buying and buying and buying throughout 2023. But despite that, actually, the share of gold in our country's total reserves is actually only 2%, very low, very low. So is MAS going to increase buying? Maybe. But yet, emerging markets on average, most non-developed countries are really only holding about 20% of gold as a proportion of their foreign reserves. And there is a lot of room for these central banks to continue to buy. And actually, that has been what is happening. Some very strong buyers, a very strong buyer of gold in recent times actually has been the People's Republic, the PBOC, which is the central bank in China. The interesting thing is China in the past they have never disclosed their gold holdings, but of recent, they have started to do so. It's almost as if they're sending a message to the world and letting the world know that, hey, we're buying gold. And they have been buying it in droves. So they have increased their gold holdings as a percentage of their foreign reserves from 2% to actually now, the data was just released, 4.9%, but still a lot of room to grow. So if you look at kind of what happened in Russia, so just to give you a sense of how geopolitical tensions would affect the price of gold, right? So during the Russia and Ukraine war, Russia was effectively sanctioned by the US, so they can't really use the USD. So they started to ramp up on their gold reserves. So to what it is today, about 60%. Russia holds about 60% of their total foreign reserves in gold. China, would one day China be sanctioned by the US? Is there that possibility as well? Is China increasing their gold reserves because of this possibility? I mean, all that can be speculative. There's a tons of different possibilities, right? But given what's going on today, geopolitical tensions between China and US, it's not a surprise that there are many central banks, especially China, but there are many central banks around the world trying to increase their gold reserves because gold is so well regarded. I mean, today, most of foreign reserves are actually US dollars, but why US dollars? Why not gold, right? So that's kind of shifting mindset within the central banks to increase their gold holdings. And this is why we think that the outlook for gold continues to be quite positive. And with that, I will end my presentation. So thank you very much. My booth is level 5. Please feel free to come and chat with us. Thanks.